Hi, I'm Steve. I'm going to share my thoughts on how you can achieve a better financial future. Please remember, I don't know anything about your situation, so think for yourself and use what fits. Welcome back to our discussion of practical finance topics. Let's cover a few terms and topics associated with the stock market. As in most areas, the terminology can make the simple seem complicated. Let's clear that up. Mutual funds are a wonderful thing. They're offered by many brokerage firms like Vanguard and Fidelity and enable a level of diversification that only large investors could have afforded otherwise. Each mutual fund is a basket of many stocks, and you can buy a tiny share of all of them by buying the mutual fund. The terms active and passive describe the style of a mutual fund. A passive fund will contain stocks that replicate an existing index, such as the S&P 500. The fund manager of a passive fund is mostly just a computer that keeps up with any changes in the index. Did you know that the first mutual fund based on a passive index was invented in 1974 by a gentleman named John Bogle? It was indexed to the performance of the S&P 500 and offered to investors at what were then rock bottom rates. The name of the small company he founded was Vanguard Investments, since grown to be the largest mutual fund company in the world. An active fund is one where a professional portfolio manager selects the companies the fund invests in. The manager's goal is to beat a comparable index and to beat it after paying for the extra expenses involved. As an example, a manager who invests in large American companies would need to have results better than the S&P 500 index after subtracting the fund's fees. It's a tough challenge, and you should look at their performance history before investing. Over a reasonable period of time, make sure the manager is earning her fees by delivering superior results. There are two types of mutual fund fees. The first is an annual fee for managing the fund, which is expressed as a percent of your investment. This fee can range from 0.1% to over 1%. Passive funds should generally be well below half of 1%. An exception might be a fund investing in emerging economies due to the difficulty of investing there. Active fund annual fees are often closer to 1%. The key here is to ensure the results warrant the fees. The second fee type is one you should never pay, in my opinion. This is a one-time fee called a load. It's a percent of your investment and is imposed either when you buy or when you sell. Generally, these fees move money straight from your pocket into the pocket of a salesperson, advisor, or broker. Well, that's it for this session. Thanks for watching, and I'll see you next time.